you folks have actually looked at what your savings account is earning you right now? If you have not, I would suggest don't doing it. Most of them are under 2%, if not under 1%. So let's say you have $1,000 in the bank and your account is earning 1% interest. Simple interest, $1,000 at 1% a year would yield you $1,010 at the end of the year. You earn $10 on your savings account. Compounding interest, so this would be you are rolling your earnings back into your account with daily compounds every day. The amount that earns interest grows by another 1 365ths of 1%. So at the end of the year, the deposit has not grown to $1,010, it's actually grown to $1,010 and a whole 19 cents. Let's compare this to CD. So here's the current average rates for a CD. I pulled this up for the week of March 30th. So a 1-year CD is earning 0.20%. A 5-year CD is 0.36%. A 1-year jumbo CD rate is 0.21%. And a 5-year jumbo CD rate is at 0.37%. with a money market account rate at 0.07%. I think we could probably find you something yielding a little bit higher. But the national average rate for 1-year and 5-year CDs started to increase in February. This was driven partly by rising Treasury yields and the expectations of the Federal Reserve rate increases of 2022. All right, bonds, 10-year Treasury bonds are at 2.385%. Not super exciting. The stock market is all over the board, as you can see. This is the S&P 500 index. So all of these low-risk investments are available to non-accredited investors, which is exciting. You know, in the past, historically, real estate trusts were only for high net worth individuals. So you had to be an accredited investor to invest. So naturally, a lot of clients, you know, I would say more people are unaccredited than actually are accredited, would turn to these low-risk investments because one, they're available to non-accredited investors, and two, they're low risk. So things like your savings account, things like savings bonds, certificates of deposits, money market funds, treasury bills, notes, bonds, and TIPs, corporate bonds, dividend-paying stocks, and preferred stocks. But with little risk comes little or no return. And that's, I mean, really, I believe that that's not necessarily true. I do believe that there are other opportunities out there that are higher returns, but I don't necessarily believe that they are much higher risk. But you do have to take some risk if you want some higher yield. So we're going to talk a little bit about some different options, whether that's with us or other operators. There are other options out there, and I think it's important for you to educate yourself and do your due diligence and your homework. So stocks can be volatile. Look at COVID. Bonds can be miserable. We saw the yields. CDs can be laughable. So what is passive investing? And how do you make your money work for you? You know, I get a lot of clients that will call and say, I want to invest in real estate, but I don't have enough capital. You know, I want to go out and buy a piece of real estate, reap the benefits of fixing and flipping it, but I don't have the capital. I don't have the time. I have a full-time job. And I don't think that people understand that investing in a real estate trust or fund reaps you the same benefits, but you're not having to do all the heavy lifting of it. You can let an operator like us manage it, and then you still get the benefits and the earnings and the yields from being in that trust or that fund that you would trying to do it yourself. So I just, again, don't think enough people are educated about it. So investing into a mortgage fund has a lot of benefits. It's hands-off. You don't have to deal with tenants and toilets. You don't have to deal with subcontractors. You don't have to deal with finding the opportunities out there. Let our team do that. We have an acquisition team. They go out, they find these deals that we invest in. You know, we have 5 to 6 people that do that. And of course, we're going to find a lot more deals than one person trying to do it at night after their full-time job, right? So there's strong, tangible assets that are securing our fund. So what I talked about is that our funds are diversified. And what I mean by that is that we take 75% of our fund balance and we lend that money out through Kogo Capital. So all those loans that you brokers are brokering to us, all those loans that you guys as real estate investors are coming to us for funding, those are the loans that we originate through our funds. So we take 75% of the balance of our funds and we originate loans and lend that money out. So the fund and essentially the members of the fund make money through things like origination points. That's part of the streams of income and profit coming into the fund. The fund makes money off of interest payments every month when your borrowers are making interest payments, or if you're an active borrower, when you're making your interest payments, our funds are making money off of that. And so that is a big stream of income that comes in, is off the loans we originate. And that's nationwide. The other 25% of the fund balance is actually invested in real estate assets in our local markets. So specifically in the Pacific Northwest, Spokane, Washington, Coeur d'Alene, Idaho, our acquisition team is out finding deals for us to invest in. When those projects are purchased and then sold, those profits flow back into the fund, and if you are a member of the fund, that is another part of the earnings that you make. So that's what I was talking about, diversification. As a fund management team, we feel really strongly about having multiple streams of income. It's no different than the way that you guys would diversify your own portfolio. If you're solely relying on one source of income to earn money or to grow your accounts, you're in big trouble if that dries up. So we do diversify that way that, because of the fact that we diversify, we can look at our portfolio and say, great, our origination team is killing it. Let's not buy as many properties, or maybe it's slow with originations, we can buy more properties. So it's a way for us to balance our funds and also continue to create consistent yields and earnings for our clients. So you can receive consistent quarterly or monthly income. One of our funds pays out on a quarterly basis. The other fund pays out on a monthly basis. The monthly basis fund is really nice for you guys that are looking for cash flow. Maybe you have been self-employed and you sold your business and now you want to put that money to work for you. Instead of having to live off the money that you've saved up and created wealth for yourself through the sale of your business, why don't you put that money to work and live off of your earnings? That's your cash flow model. For those of you that are more growth-minded, maybe you don't need the cash flow right now, but you want to focus on growing your account, you could put it in what we would consider growth mode. So you can reinvest your earnings and now you're compounding your earnings, okay? So quarterly or monthly income, diversification of your portfolio through high yields. So the thing that I always look at is, the client that I have that has $50,000 and he wants to go buy a note, and we're going to talk a little bit about what that means to actually invest and buy notes. But this client wants to go and buy a note, but he's also looking for cash flow, which is great. There's a lot of opportunity with that. The risk is if his borrower stops making their payment, his cash flow stops also. If you look at the fund model and you take that $50,000, that $50,000 is diversified over hundreds of notes. So it doesn't hurt as much when one borrower doesn't make their payments. So in my opinion, the fund model would be the better option for somebody like that that's looking to create cash flow. If I've got my guy that is hedging the bet that he wants to lend on a note that has 30% equity, and he's looking at that as his potential yields, then the note is the better model for him, okay? So it really just depends on your strategy, what you're trying to accomplish, and that's something that me and my team will talk with you about if you want to have a consultation. The benefit to the fund also is you're always deployed. So one of the worst days of a note buyer is typically when he gets paid off, because why? He has to find a new home for his money. With the funds, you're always deployed. Those notes are rolling in and out of there. Those properties are being bought and sold. You don't have undeployed capital. With notes, when you get paid off, we got to find another home for it. So there may be a period of time where your money's not working for you, especially if you're using IRA funds. For those of you guys that have self-directed IRAs with self-directed custodians out there, you know that they have processes and it takes some time. So, in my opinion, the funds are a nicer option if you want to just keep that money working all the time. Our funds are IRA friendly. So, how many of you, let's see, I'm going to take a poll real quick. How many of you guys know that you can roll an IRA account to a self-directed custodian, or you could roll an old 401k over to a self-directed custodian, and you can invest in notes and funds? Anybody on here doing that right now? Norton is doing that. Awesome. Carolyn, yes, Carolyn, I know you're very active with your IRA. Quite a few of you. That makes me happy. I'm a big proponent of this. IRAs and 401ks, which are tax-deferred accounts, can be set up with self-directed custodians where you direct how you want to invest in it. Our notes and our funds are IRA friendly, so we can help you with that. I'm not going to get too far in the weeds with self-directed custodians and accounts like that. I feel like that's a whole nother webinar. But if you want to speak with me and my team about that, we'll have some information at the end how you guys can schedule an appointment. I would highly recommend educating yourself about that, because it's a way to actually invest tax-deferred or even tax-free if you're talking about a Roth. So we can talk a little bit more about that. But just on that note, funds, both of our funds are friendly to self-directed IRAs and 401ks. We can help you with all of that. All right, so we're going to talk about our experience. We meet as a team often. There's actually 3 of us that are, the people that actually make decisions on the fund, but there's a massive team behind us. We meet on a regular basis every week about multiple things, portfolio management, underwriting, lender committee. But one of the things that we talk all the time about is preservation of capital. So what is Secured Investment Corp's strategy with these funds? One is preservation of capital. That is first and foremost. The most important thing to us is to return people's capital in whole to them. Second is well-secured assets. Right now, we are focusing on the affordable housing marketplace. Single family up to 4 units is really kind of our niche. We don't lend above the FHA cap. We don't buy properties where the resale value is going to be over the FHA cap. And we're very strategic about that, because when markets start to shift, what do real estate investors turn into? They turn into landlords. So when you're in that affordable housing market space and markets shift, or you bought a house and it's not worth what you thought it was 10 months ago because it took you too long to rehab it, more often than not, if you're in that affordable housing market space, there is still opportunity to cash flow that project. You could rent it out. You could ride the market shifts out. And so we really focus around that. Again, that single family 1 to 4 units with equity. They have to have at least a 30% equity play in them. We don't only focus on the asset, but we also focus on the borrower and the guarantor's ability to pay and exit the loan. And this is something that I actually pride myself on. I've been in the private money industry for 20 years, and you start talking with people, oh, you're a hard money lender, you're loan to own. That is not who we are here. And for those of you that have dealt with us, I hope that you see that. It is as important for us, for our borrowers to be successful and to exit our loans, as it is for our investors to earn good yields on their money. And so we do a pretty, big due diligence process on our borrowers. And it's not just to rake them over the coals, it's actually to make sure that we're setting them up for success. I can't tell you how many lender committees I've been in where I've said, I don't think we're putting this borrower in a good position. This borrower can't finish the project. They have no experience. There's not enough equity in it, and I don't know how they're going to exit the loan. So we do look at the borrower. We look at their financial situation. We look at their experience. And we want to make sure that we're well positioning them to exit the loan and make money. So again, we look at the asset, making sure at the end of the day we're well secured, but we also focus a lot of effort on whether we're putting that borrower in a good position to be successful. We also want to understand all markets. It is not uncommon if we are being asked to lend on a loan that we're not familiar with the market, because we have such a broad reach with all of our students. If we don't understand it and we need boots on the ground, we'll get in our database and we'll find someone in that local market to give us a little more insight on what the project's about. But I do believe we have a really good understanding of all markets. We utilize a lot of third parties for fund management control. So we rely on appraisers and inspectors and attorneys. We use third-party appraisals or evaluation tools to determine what the value of the property is, and then we look at it internally. We use inspection companies. So for all of our loans that we're lending money on that are rehab loans, we actually outsource third-party inspections to a rehab budget management company that will go out, identify whether the project is moving along, if the work has been done, the materials have been purchased, and then providing that that information comes back accurate, then we will reimburse a borrower for draw. So we always want to make sure, again, we're protecting the investor and the funds, but we're also setting the borrower up for success too. We have a third-party servicing company, Lake City Servicing. They do all the collection efforts and collections for our borrowers, and then they disperse all those payments to our investors. And then we utilize a lot of attorneys for legal situations. Strategy also is customer service, quick response, hands-on approach, full transparency. I am in a couple different mastermind groups where we raise a lot of capital from all different kinds of people, high net worth individuals, people that are just getting started investing. And the common theme that I hear from everybody, which is a little surprising to me when you're dealing with people's retirement accounts and helping people create wealth for themselves, is that we have the quickest response out there. Apparently people don't call people back anymore. They don't respond to emails. That is something that I instill in my team, that they do not go home for the day unless they have responded to all emails and voicemails. It's extremely important to us. And even if we don't have the answer right away, someone is going to respond to you and let you know that we are working on it. So I do believe that we probably have the best customer service out there as far as an operator is concerned, because we want you to know that it's as important to us. We don't take it lightly that we're helping you invest your money, and so we want to have quick responses to you. Timely and detailed reporting. Our accounting team, and I'm going to show you guys some examples, do an awesome job at our fund reporting, and you guys will get to see a little taste of that. And timely and end of the year tax reporting. When you invest in a fund, typically you're going to get what's called a K-1 instead of a 1099 because you're investing in an LLC. That is a huge sore subject with people that invest with funds. There are a lot of operators that don't get them out till June and July, which means you are now going to be filing an extension. We already have ours out. They are to be out by March 15th. And they go out in a timely fashion. It's important to us so that you guys can get your taxes filed if you aren't filing extensions. So timely end of the year tax reporting, that's a big one. So what I'm going to show you on the screen, this is just a little snippet of a fund report that is actually for Fund 2. And this is actually year-to-date numbers. So for those of you who can see on here, we've got and this is from inception. So this fund actually had first earnings in Q4 of 2014, and then we do year to date for all the years, and then we break it up when it is in the actual year. So for example, this was year to date 2021 for Q3. So you get to see a lot of transparency. You'll see what the equity balance of the fund is. You're going to see total fund earnings for the period, and then you're going to see total amount paid. So these are actually yields that we paid out to investors. So Q3 of 2021, we paid out $875,000 in earnings to our fund members, and the yield was 10.8%. And then when you go down a little bit lower, this is the activity of the fund. So remember I told you guys that the fund is diversified. 75% is held in loans we originate, and then 25% is in properties that we participate in our local market. So this whole area is going to be number of loans originated, the dollar amount of the loan. So you can see that in, let's look at 2015. We originated $5.6 million in loans for a total of 88 loans. We sold 96 of them, so there's always some carryover, and we sold about a little over $6 million in loans. Year to date for quarter 3, we had originated 99 for a dollar value of 12.7. You can see how much this fund is growing, and we sold $10 million in notes. So it's exciting to see those numbers. And then property activity. This is going to be the number of properties that we purchased, the dollar value of those, and then the number of properties we sold with the dollar values of the properties sold in that quarter. So this report is what you guys get when you invest in the Secured Investment High Yield Fund 2, and you get this on a quarterly basis. So I mentioned transparency. This is really important to us. We believe really strongly in being transparent with our fund members and clients in general. So year to date, we've raised just about $29 million. Now this was at the end of 2021, so keep in mind it has increased since then. Loans originated at the end of 2021 was $93 million. We purchased 127 properties, and average days held is about 157. So in 2021, our average yield was 11.36%. So that beats, I think, the real estate trust called Apartment Income Trust that had a yield of 3.4, don't you think? A little bit better. All right. So this is the Circle of Wealth Fund 3. So you might be saying, well, why do you have 2 funds? What's the difference? The funds are diversified the same way. They are managed the same way. However, the Circle of Wealth Fund 3 is for anybody. You do not have to be an accredited investor to go into it. The minimum investment is $1,000 for you guys that have old 401ks. Oh, I think, I talk to people all the time. I worked somewhere like 2 or 3 jobs ago. I don't think I ever moved my 401k. It's no big deal. It's only like $5,000 in it. It is a big deal. Roll that account over to a self-directed custodian, put it to work in the Circle of Wealth Fund 3, and you're yielding a little over 8%. It's probably better than where it's sitting right now. So Circle of Wealth Fund came around 4 years ago. Again, I mentioned this earlier, we have a big passion. We don't think that only high net worth accredited investors should be able to invest in real estate trusts. And so we opened up the Circle of Wealth Fund 3 that is open to everybody. It's got a minimum of $1,000. So that's pretty exciting. There's not a lot of real estate funds out there that are for non-accredited investors, okay? So this is a $10 million offering. Like I mentioned, it does have a minimum investment of $1,000 with a preferred rate of 6. So what that means is the first 6 goes to you guys, and then everything is split 50-50. It's been yielding an 8 to 10%. So still a really strong yield. And then this is also the fund that I mentioned has great cash flow. For you guys that are looking for cash flow, meaning you want to see monthly interest payments coming in, you want to live off of your earnings rather than deplete your balance of your principal that you've saved up, this is the perfect fund for this. It's also really good if you guys want to put it in growth mode, so you can actually reinvest your earnings into this fund. So this is a example of the reporting that we do for this fund. Very, very similar. We're going to show you equity, which is dollars raised, how many members are in the fund, how many loans we've originated and held, and then properties, okay? So you still get really good reporting with this fund. Year-to-date balance, it is a little over $5 million. Year-to-date loans funded was 8.3 in 2021. We sold about 5.9 million. We had an annualized yield of 8.19%. So still really, really good yields on your money, okay? This is the fund with $1,000 minimum. So you might be asking yourself, and I get this question all the time, well, this sounds great, but I don't really understand how the fund makes money. How does the fund make money for me if I'm a fund member? So let's just kind of recap. When the fund buys a property and they invest in a project and we sell that property, the income from the sale of that property flows back into the fund. So we have all these profit buckets coming into the fund. So one is from the income and profit from the sale of actual projects. Another is from origination points. So when we originate a loan, I mentioned this to you guys before, all the loans that go through COGO and we originate are originated through our funds. The funds earn 20% of the origination points. So they get revenue from there. Then they get paid the interest rate. So your borrower that you brokered the loan to is paying us 12%. We're going to earn 12% through the interest payments that your borrowers make until we sell the note. And we're going to talk about notes here in a minute. So we sell the notes. So if we write a note at $100,000 for 12%, we're going to sell that note for $100,000 at 10. That way the fund gets its $100,000 back. The fund keeps earning 2% on the interest strip. And then the end lender that bought the note is now the lien holder, and they're earning the 10%. So instead of only being able to originate $5 million in notes, we will turn that fund over and over and originate $10 million in notes. I'd much rather earn an average yield of 3% on a $10 million portfolio than 10 on a $5 million. Make sense? All right, so we're to the notes. By a show of hands, or maybe just some comments. And I'm gonna also answer some questions for you guys at the end of the presentation. So keep your questions coming in. I can see quite a few of them in here, but I want to make sure you guys know that we're gonna address as many of those that we can at the end of the presentation. Maybe by just a comment for those of you that are on. Are you buying notes right now? Tell me if you are, and if you're active. That might help just kind of shed some light on who's actually active. So Tasha is not. Anybody else on here buying notes? No, Norton's not. All right, quite a few aren't. So this is good. So investing in trust deeds and notes. So I talked to you about the funds. I talked to you about the fact that the notes that we originate on the funds we sell. We do that so the fund can recoup its capital and it can continue to originate more notes for you guys, and therefore is more profitable. So traditionally, institutions and ultra high net worth investors for decades have used this strategy as a wealth creation tool. Typically, to invest in trust deeds or notes, you would need many times over $250,000 just to buy a note. Secured Investment Corp offers trust deed and note portfolios that are designed to solve this problem and allow investors, regardless of their net worth, the ability to gain access to the same product with a much smaller dollar amount, with as little as $30,000. So we do sell notes. We only sell whole notes, meaning you have to buy the entire note. So if it's a $30,000 note, you would have to fund $30,000. It could come from your IRA. It could be a combination of personal funds and your IRA. A husband and wife could partner, so there are some caveats to that, but ultimately the whole $30,000 would have to be funded. So let's talk about what trust deed investing really is. So trust deed investing means you are acting in the capacity of a bank. You are loaning your money to a borrower who will utilize the capital to add value to a piece of real estate. So when you buy a note, your name is recorded as the lien holder, making the respective property collateral. This protects your investment, and monthly interest payments are paid with the principal returned at the time of payoff. So when you fund a note with us, we assign our interest in the promissory note and the security instrument. That's either going to be the mortgage or the deed of trust. And then we record an assignment at the county level that identifies that you are now the lien holder against the property. So you're acting as the bank. How does it work? So the loan, underwriting, origination, capital fundraising, loan servicing, tax reporting, and statements, foreclosure process, property management, and sale of the property are all conducted by us. These are loans that are typically short-term, ranging from historically 6 to 24 months in duration. And during that time, you're earning monthly fixed income of up to 8 to 11% historically, and that is an annualized interest rate. So for each trust deed or note you purchase, you receive a recorded assignment of mortgage or deed of trust, an assignment of the promissory note. You have title insurance ensuring your first lien position. These are all first lien position performing notes, and liability insurance on the property is also provided, so hazard insurance. So a couple things to just kind of touch base on. When you buy a note from us, this is a note that we've already originated. So we're not that lender that's just the middleman. Hey, John, I got a guy out of, Spokane that wants to borrow some money. Let's hook you guys up. We actually originate the note, and I think the difference with that is we are originating it like we're keeping it. There's no guarantee that we sell all these notes out of our fund portfolio. So it's extremely important for us to do our due diligence, go through the underwriting process. So these are originated notes. They're also performing notes. I get a ton of people that call, I want to make you an offer. We're going to buy a discounted note. We don't discount the notes. They're not non-performing, underwater notes. These are newly originated notes with new appraisals on them, newly underwritten, and people are making payments. So we do not discount our notes at all. If you're someone that's looking for a note and you just want something very turnkey that's already paying, these are the types of notes. That's not to say that that's not a good strategy to buy non-performing notes, but there's usually a lot more due diligence that goes into that. Then once you buy it, typically you're going to get it performing again and resell it. So that's not what we do. These are performing notes. Again, I mentioned to you, we typically only lend in a first lien. That's not to say that there aren't other options. You can buy second liens out there. We don't offer that at this time. I will tell you there are high yields with seconds, but there's also a lot of caveats that go along with that. If you're going to buy a second lien, be prepared to understand what's in front of you so that in the event you have to take them out and buy out the first lien to secure your lien, you're prepared to do that. But we offer first lien position notes only at this time. It's important to remember that all first position notes have priority over a second position note, and they must be set aside before consideration of a second position note in the event of default. And so that is really the reason that we only lend in a first lien position. We also make sure that you have title insurance insuring your first lien. We also only lend to non-owner occupied residents. These are for business purposes only. We only lend to LLCs or entities in good standing, and then any member of that entity that is a 30% shareholder or more will also have to personally guarantee that. So that's another selling point as a note buyer is, one, you have a first lien against the property. Two, you have personal guarantees from the guarantors of the entity that says that in the event that you experience a loss, you could actually go after them for a deficiency judgment. We don't do any owner occupied. Their kids can't live in it. Any family member lineal would be considered owner occupied. So again, these are all non-owner occupied. So I mentioned a little bit about different types of notes, performing versus non-performing, and there's opportunity in both. One of the things that I can appreciate about Lee and the team is we've always made the decision to stay in our lane. So we're not trying to be the lender for everybody, and we're not trying to sell non-performing and performing and discounted notes. We kind of just stay in what we're really experts at, and that's really in the performing note space. There's levels of performing notes such as reperforming or subperforming. This typically alludes to the length of a borrower has consistently or inconsistently made payments. But again, the notes that we sell are all performing notes. So when a borrower stops making payments on their notes, it becomes non-performing. That means they're not making their payments anymore. And quite honestly, that's where people see a lot of upside. Okay, I'll buy that non-performing note. I'm going to buy it at 80 cents on the dollar or whatever that discount is. Typically, the strategy with that is to get the note performing again and then go and resell it, recoup your 20% equity and whatever other earnings you had. So again, there's great strategies with that. That's not what we do, but that's typically what people are referring to when they say, do you sell non-performing, or can I buy a discounted note from you? So let's talk specifically about the types of notes that we offer here. So they're short term. I would say our average loan term is 12 months, but we will go up to 24 months. The minimum loan amount is going to be $30,000. So again, you do have to buy a whole note. I'd say that our average length of our notes is probably about 10 months. Most of our borrowers pay off a little bit early. So for you guys, on the presentation that want to charge them prepayment penalties. We don't do that. And the reason we don't do that is we want our borrowers to be successful. If they get in and out of a deal quicker than they thought, or they find cheaper, terms somewhere else if they're going to hold it, that's awesome. We want to congratulate them because then they will come back and borrow again from us. So we're not going to penalize them for paying us off early. Some lenders out there say, well, it's not worth me moving my money around if I'm not going to get at least 90 days of interest. The really cool thing about also owning the servicing company is we know exactly when those loans are going to pay off. I just did one today. One of my investors that bought a note from me said, hey, I just heard from Lake City Servicing. I'm getting a payoff. Let's find another note. We're turning his money in 24 hours. So the thought that you're going to have undeployed capital and you want at least a minimum 90 days of interest, you don't need that, because servicing is going to let you know when you're going to get paid off. You're going to work with me and my team. We're going to let you know, hey, John, you're getting a payoff. Let's start looking for another note so we can turn your money really quick. So there's no need for that. And it encourages our borrowers to come back to us instead of penalizing them for accomplishing things earlier than they thought. We want to encourage them to be successful. Again, they're going to be secured by a first lien and a personal guarantee. So first lien against the property. The personal guarantee is the guarantors. So the people that are members of the entity that have at least a 30% share hold in that entity. They're all going to personally guarantee it. Our borrowers make interest-only payments. So every month, our borrowers are set up on ACH payments. Their payments are due on the 1st with a 5-day grace period. So we let them pick between the 1st and the 5th when they want their payment pulled. When their payments are pulled, we hold them for 7 business days, and then we disperse them to you guys as investors. We can send your interest payments ACH. That's what most people do. They get it the quickest. You'll get a nice little email. Hey, Peter, we just deposited $550 in your account for such and such loan. So it's a very passive process. Again, these loans are all secured by residential single family up to 4 units and non-owner occupied. And this is all in the affordable housing market space. So the easiest way to think about it is anything under the FHA cap. And for you that don't know why we do that also, is when you're looking at properties and their resale price is over the FHA cap, your pool of buyers is much smaller than under the FHA cap. Under the FHA cap, you've got first-time home buyer programs. There's just a much larger database of clients that will actually be able to buy houses if you stay under that FHA cap. So that's why we do that, and that's why we encourage our clients to do that too. Purpose of loans, purchases and refinances. The only time that we typically, well, not the only time, but purchases, obviously, we can supply money for people to go purchase a property and also rehab it. And then some of our clients that are really savvy, they will actually leverage properties that they already own and do a cash out refinance. There's nothing wrong with that. Obviously, they're sophisticated enough to have enough equity in a property to refinance it. So we will go up to a 50% loan to value on cash out refinances. And then sometimes we do a refinance of another lender. An example of that would be somebody that maybe used a private lender to buy the property and now they need money to actually rehab it. We could potentially, if there's enough value there, refinance the current lender so that we can actually get them paid off and still be in a first lien position, and then provide them with the funds to rehab it. So there's a lot of different reasons for refinances, but those are your typical ones. Oops. I think I skipped a few here. Okay. And then newly originated loans that have been fully underwritten and vetted. So one of the things I want to talk about is, and we'll talk about this in the next slide, maybe I'll wait to kind of explore that. So what does a life cycle of a trust deed note investor look like? So typically they identify the deal. If you are interested in starting to see our notes, what we have available, you're going to see contact information at the end of this presentation. I want you to let me know. We'll get you on our email list if you're not already on there. We probably send out 6 to 8 emails a week of new deals. So every time we get a deal out of underwriting and it's cleared to close, we will blast it out to our active investors that are looking for notes. That's the quickest way to see the most recent inventory. You can also visit our website at Secured Investment Corp. And we have all of our mortgage notes on there. So those would be the two best ways. And then obviously talking with someone from my team, letting us know what you're looking for. What I tell people, and I get people that, you know, hey, I went to a seminar about buying notes. I want to look at 10 of your notes. I will not send note packages to people unless they sit down and they write out what their strategy is. And what I mean by that is identify what you want to see. Maybe it's location. Maybe, hey, I only want to see deals in Texas and Florida. Great. That helps you weed it out. I only want to lend to borrowers that have experience, or I only want to lend to borrowers that also have a job outside of real estate investing. So identify what your strategy is also. Is it cash flow? Is it, you know, growth? Hey, I don't mind lending and doing something a little riskier at, you know, 80% loan to value if it's in my own backyard. So, you know, really sit down and write that list out, because if you just start looking at every loan package out there, you are going to have analysis paralysis. You will never make a decision. So I personally don't let my clients even look at loan packages unless they write that out and we have a conversation about it. So identify what you want to see in a deal. And then you identify the deal. We provide our clients with what we call a loan package. This is everything that we use to underwrite the deal. So if you call me up and you say, hey, Heather, I want to see that deal out of Texas, we're going to talk, we're going to have a conversation. I'm going to identify that you know what you're looking for in a deal, and then I'm going to send you the due diligence package. And what's in that due diligence package is everything we use to underwrite it. Appraisal, evaluation, rehab budget, all the information on the borrower, their financial information. We keep everything private and we redact sensitive information, but our clients want to know, hey, does this person have the financial wherewithal to make the payments, to front the rehab budget, and are they going to be able to exit the loan? Credit reports, background reports. So you get all that information, and we encourage you to do your due diligence and make a decision if you want to move forward. Once you decide, we create what we call transfer documents. So this is what we were talking about. We transfer our interest in the promissory note to you. We transfer our interest in the security instrument, whether that's a mortgage or a deed of trust, and we sign everything around. We do this all through DocuSign. We send you wire instructions. If you're working with a self-directed custodian like an IRA account or a 401k, we will help you with that paperwork too. And then you transfer funds. Once your funds are transferred, we set that up in servicing, and you start earning your monthly interest payments. Once the borrower gets ready to pay off, you're going to get notified, hey, Peter, your borrower out of South Carolina is paying his loan off. Here's a payoff quote. Can you approve it? That way you know when you're getting paid off. Then you're going to work with my team and you're going to say, hey, and servicing lets us know. Usually we'll reach out to you before you get to us, but we'll let you know, hey, we understand you're getting paid off. Why don't we start looking at some other options for that? If you're ready to just redeploy, we can make that happen very quickly. Or if you're wanting the funds sent back, we would obviously do that also. So that's just kind of the life cycle of it. And it just, I mean, I'll be honest, people just turn these notes over and over, and it's very easy, it's very passive. In the event that there was ever any problems with the account, like the borrower didn't make his payment, we're going to hold your hand through that too. We're going to help you walk through a defaulted note process, and that may mean foreclosing. We will do that for you. We're not going to leave you just out there to figure out what to do. So we're in it till the end. We're in it till your capital is returned, and we have a lot of clients that are very successful buying notes. I would personally say that my client that buys notes is probably someone a little more active, somebody that likes to do their due diligence, likes to dig into the file, likes to be a little more selective as far as, you know, maybe it's location, maybe it's the experience of the borrower. Where my very passive people that sold their practice, are wanting to retire and travel, and they don't want any headaches of it, those types of people passively invest in the fund. The reality is they are the same investments. They are the same assets. The notes that you're buying are the same notes that are in our fund. You just have to decide, do you want to manage it or do you want us to do it for you, right? So, one-off investor. Are you someone that's active buying notes? Are you an accredited investor that would go into Fund 2 with a $50,000 minimum? Or are you beginning Fund 3 investor that's wanting to just deploy their capital, has maybe some smaller dollar balances. I will tell you, I have accredited investors that are in Fund 2. I actually met with a client today that's a very high net worth individual, but she just got some inheritance money that she wants to keep in a family trust, and she's putting it in Fund 3. So there's options to do all of it. I think it really just boils down to what you're trying to accomplish, and that is something that we'd love to have a conversation with you guys about, and definitely help you understand what options you have out there. Again, we're not financial advisors. I really look at us as more financial educators. We're going to tell you what your options are, but it's ultimately up to you to determine what's the best pathway for you, and it could be multiple pathways. I can't tell you how many of our clients do multiple things. They don't just do one thing. And I think it also kind of depends on the dollars you're working with. Are you working with self-directed IRA accounts? Are you trying to create, passive cash flow for yourself, or are you more growth minded? And that's definitely something that we can help you, better understand what those options may provide you. So I do encourage you guys all, and I'm going to take some time to answer some questions. I see quite a few questions, but if you're interested in talking with me and my team more, you can go to the link that's on the screen right now, learnoldsystem.com/April, and you will be able to schedule an appointment with myself and my teammates, Kate and Lisa, and we'd love to talk with you a little more. But let's answer some questions here. So hold on here. Let's see if we can. Do I need to unmute them?
Yeah.
Okay, here's a bunch of questions.
You can select one at a time, it looks like.
I have just like all the questions pulled up.
Gotcha. Do you have a mute option or unmute next to one of them?
I do not.
Let's see.
Let's see.
Because you can go back. Okay, so if you go to the attendee list,
Uh-huh.
you see the question marks?
Yeah.
There's a table of quick questions, and you can click their mute and ask them to unmute.
Oh, okay. All right, we're going to give this a try
Or at the
here.
bottom, you can mute all participants or unmute.
Muted.
Okay, so Yvonne, it looks like you might have had a question. I'm going to try to unmute you. It looks like you might have muted yourself.
At the bottom of the attendees, you can unmute all.
Okay, what's this? Mute. Okay,
See it?
yep.
Unmuted.
All right, Yvonne, are you still with us? I think she might still be muted. How about Vivian? Can you hear me, or can you give us? I think they're all muted.
Yes, ma'am.
Okay, is this Vivian?
Yes.
Okay, did you have some questions?
Well, I had a question regarding the funds being sold, but you more or less answered it.
Okay, and what did you mean by being sold?
Well, I used to work in the mortgage business, and I know that loans were sold all the time.
Mm-hmm.
So that's what my question was regarding.
Yeah, and what Yvonne is or Vivian's talking about is in the more traditional mortgage industry, they sell portfolios of loans, meaning, they may, and for any of you that have a mortgage on your home, have you ever had your lender contact you and say, hey, we're not servicing this anymore, you need to send your payments here? It's because they've sold your loan. We do the same thing, but on a smaller level and with really just one-off lenders. We have some bigger entities that buy bulk paper, but for the most part, it's really just one-off investors that invest in funds. But that's a good question.
Thank you.
You're welcome. All right. It looks like Tony might have a question. Are you still on, Tony? All right. I'm not sure if Tony.
I don't have any question.
Oh, okay. I just saw the question mark next to your name. Thank you.
I was just mentioning secondary market when they sell it too.
Oh, okay. All right. How about Tim? Tim, do you have some questions?
No.
No?
When you were asking about, is everybody muted or not, I thought I'd try it out. Let's see if I so forgive me.
It's okay. I just want to make sure everybody gets their questions answered. Let's see here. All right. It looks like you guys had, I think we got the sound taken care of, but let's, all right. Is it, oh, this is a good question. This person says, is it possible for a non-U.S. person, so a foreign national living outside the United States, to invest? You can invest as long as we have a way to report your earnings. So, for example, I have quite a few clients from Canada that they invest with us specifically into our funds. So you can invest if you are not a U.S. Citizen, as long as we have a way to report your earnings. But that's a good question. All right, let's see what else.
Lee says just to read the questions and answer them.
Okay. Is the training to learn where to get borrowers to bring you to... hold on, let me just expand this so I can read your full question.
Muted.
Is the training to learn where to get your borrowers to bring you to, I think, Martha, I can't read the full question. Sorry about that. Oh, here we go. One quick second. I want to get back to your question real quick. Okay, is the training to learn where to get borrowers to bring you to get a loan? So Martha asked that. I'm not sure if you're talking about the broker certification program. If you are, Martha, we can get someone to get you more information about that. That program is a class that's going to educate you and teach you on how to set up your brokered business so that you can be essentially a mortgage broker and broker deals to COGO, and it will actually educate you on all different types of resources for that. So if you'd like information on that, Martha, let me know and I'll get you to get someone to follow up on that. All right, we had a few more questions. How much are the notes? Are any of the notes $30K or less? So Joe and Liz asked if any of the notes were less than $30,000. They are not. That is our minimum loan amount. But the great news is you can invest in the Circle of Wealth Fund 3, which is the same asset. That's where the notes are that we sell. And you can invest with as little as $1,000. So that would be a great option, is to actually invest in Fund 3 if you have dollars smaller than $30,000. All right. Let's see here. What is the minimum investment for the fund? Shirley, minimum investment for the fund is $1,000. Let's talk a little bit about that, because you can invest more than that, and it has to be in $1,000 increments. But the only regulation behind that is the most that you can invest. So minimum is $1,000, but the most that you can invest is either going to be determined by your assets or your income. And what the Securities and Exchange says, so this is not our rule, this is the SEC, we are just very compliant. The SEC says the most that you can invest as an unaccredited investor is either 10% of your estimated income or 10% of your estimated assets. So if you believe, including your equity in your home and other investment accounts and cash, that you've got $300,000 in assets, the maximum you can invest is $30,000, but you can start with just $1,000. That's a good question, though. Roosevelt said the link to set up an appointment does not seem to be working. I tested this earlier, so it should be okay. Let's go one step farther. So leearnoldsystem.com/April. Give that a try. And someone here just confirmed that it is working, so you guys should be okay. All right, let's get back to some questions here. Do you I like this question. Do you recommend a particular custodian for people with retirement funds to work with before rolling or transferring? NN is the name in there. So yes, for all of you that are on the presentation, if you have IRA accounts or 401k accounts, or you want to start setting a IRA up, get a hold of me and my team. So visit the web or the link, and we will give you some references. I have several of them I really like, and it kind of depends on what you're going to do with your IRA. If you're just going to passively invest and put some money in the fund and buy some notes, there's some that are better than others. If you're going to be an active real estate investor, meaning you're going to buy real estate with your IRA, there's probably some that are a better option than the other ones for the passive investing. So if you schedule an appointment with us, or at least just reach out to my team, we'll give you direct contact for several of them. Just off the top of my head, some of the better ones that I've had better experiences with are Quest IRA out of Texas, Alto IRA out of Nashville, and Equity Trust out of Ohio. So those are probably my top three, but there's lots of them out there. There's Entrust, there's a handful of them, but we'd love to give you some contact information so you can do your homework. So if you have, on that note, if you already have an IRA set up or you have an old 401k, the benefit to rolling it over to a self-directed custodian is you aren't going to have tax implications. So it's not like you're taking a distribution on your old 401k and now you're going to put it in this account. They basically will help you roll that account over so you have no tax implications. Then you can start investing it the way that you want to direct it. If you don't have an IRA or you want to set up another IRA, you can also work with those custodians and set up new monies in those. There's obviously some limitations on how much you can put in an IRA in a year. But right now, the cool thing is, if you guys didn't make your contributions for your 2021 IRAs, you still have time to do that up till tax day, which I think is April 18th this year. So you still can make your contributions, $6,500 a year. And I would highly suggest doing that. So you could almost invest, $6,500 twice this year because you're doing your 2021, which you didn't do last year, and then you'll have an opportunity to make another $6,500 contribution for your 2022 taxes. But get a hold of us. We'll give you some names of some custodians. It's kind of one of my favorite things to talk about. This person, Mr. Roy, said, I have a WB-BEN from being an Indian citizen and being a tax lien investor. So is it possible for me to participate? Yes. Get a hold of us. We can help you deploy some of your capital. Martha had another question about being a broker. Martha, we'll get someone from our business development consultant team to follow up with you, and we'll get you some information on how to get you set up as a broker. Tyrell asked me, what are my top 3 personal favorite investments to make as a real estate investor in the real estate investment industry if you have under $80,000? What I would tell you is if I was buying a note, it would be in my own backyard so that I could manage it in the event that I would get it back. My other options would be to go into the fund. I am more growth minded right now. I love the option to be able to reinvest my earnings hands off. I don't have time to manage real estate projects right now. That's why I have rentals and I'm not fixing and flipping. I think the funds are a great option to do that and to invest with an operator that has a massive team behind them making the wheels turn. So I would say notes if they're local to me, and then both funds, small dollars into Fund 3, and if you are an accredited investor, the accredited investor fund. But the reality is the funds are the same. So I would look at those. I would look at a note local and then also in the fund. Anita had a really good question, and I want to bring this up. She said, is Fidelity a self-directed custodial platform? They are not. I will tell you, I've had more people in the last 6 months say, I have a self-directed account. It's with Fidelity. It's self-directed if you pick things that are on their platform. The reason they do that is that's how they get paid. It's not truly a self-directed account. Self-directed means you have a custodian that works with you. They tell you all the things that you can invest in, and they also tell you all the things that are disqualified, and they don't get paid to manage it and tell you what to invest in. So although Fidelity and some of these more traditional custodians will tell you it's self-directed in the sense that as long as you pick something on their platform, you can invest. It's not truly self-directed, meaning you can't call up a fund operator like us and say, hey, I want to invest my capital. You wouldn't be able to do that with us. So self-directed in the true sense are much different than that. But that's a really good question. And Leonard had a question. He said, I live in Washington State. I was told I cannot invest at this time. Now I have my self-directed IRA in Texas. Leonard, you can now invest. So for those of you that don't know, we cannot accept investments from residents out of Washington State, Nevada, and Arizona. Right now we are working to get qualified to do that. However, if you have a self-directed account and your custodian is from another state, like Texas, you would be able to invest. So Leonard, we will get a hold of you tomorrow and help you with that. Roosevelt also said, I'm interested in broker training and investing as well. Please contact me. Roosevelt, we will get a hold of you also. All right, let's read this one. I have already had a solo 401k account with a checking account from Titan Bank based out of Texas. So could I write a $3,000 check and send it to Fund 3, or should I speak with a consultant first? So you need to speak with us. The process to invest in the fund, in the Circle of Wealth Fund 3, is online. So what we'll do is we will actually help you set the account up online, and you can put in your check information and essentially make your investment with an ACH pull. Or you can send a check in, but we still need to set up your online account. So make sure you set up an appointment and we will walk you through that. We'll help you get it all set up. That way you always have online access to your investments. You can log on there, you can see what your earnings are, especially if you're in growth mode. It's a really nice feature because you can get on there every 15th of the month and you can see your earnings roll back into your account. You guys have good questions tonight. I love it. Let's see here.
Heather, I've got one from Facebook.
Okay.
From Leonard McKinnon.
Yep.
He's asking, if I live in Washington State, I was told I cannot invest at this time. Now I have my self-directed IRA in Texas. Am I allowed to invest?
Yep. So Leonard, I think we just addressed that one too, because I think you put that through on Facebook. Yes, now that your self-directed IRA account is set up with a custodian out of Texas, technically it's out of Texas, so you could invest. So we'll get a hold of you. That was the case if you were trying to invest as an individual and you were a resident of Washington, but now that your IRA is set up with a Texas custodian, now we could accept your funds. So we'll definitely get a hold of you. That's a good question. All right, I think we're getting to the end. Let's see here. Any last questions? Nick has a good question. He says, for Fund 2, what does the 12 months mean? So Both funds have a 12-month tie-up period. That means when you invest, you have to stay invested for at least a year. You cannot get your money out. Unfortunately, even for an emergency, you cannot divest out of the fund. After 12 months, if for some reason you want to divest out, we will start the divesting process, but just understand that it takes another 4 quarters to be fully divested out. So the easiest way to think of it is, I'm invested for a full 12 months, then it's going to take me 12 months to be fully divested out. You'll get 25% of what you're asking out. So if you put $1,000 in, you're going to get $250 every quarter for 4 quarters till you're fully divested out. The reason that we set that process in place is that money's out there working. We would be horrible fund managers if we just had that money sitting in a trust account. We are lending it out, we're buying real estate. This gives us the ability to divest you out over a 4-quarter period, so it's in the best interest of the fund. But that's a good question. All right. You guys have been a great audience tonight. I hope you found the information valuable. We can get more into the weeds on a lot of this stuff. I really just wanted to give you a general overview of the alternative options that are out there through notes and through real estate funds. I think it's great timing with everything going on. And we would love to talk with you more about that and help better understand what you're trying to accomplish. And then we can go a little bit deeper into any of the topics that I brought up once we better understand what you're trying to accomplish and how we can service you. So again, I encourage you, go to the link, leearnoldsystem.com/April. You can schedule an appointment with me and my team. We'll go a little bit farther into detail about what you're trying to accomplish and answer any additional questions for you. If you guys feel like you're ready to go and you want to invest in the fund, go to Secured Investment Corp to our main website, hit on Circle of Wealth Fund 3 and you can start investing. But if you'd like a little bit more clarification, help setting up your accounts, you can always reach out to my team. We'd love to have deeper conversations with you and see if we're a good fit for you and a good fit to diversify your portfolio. All right, I think we've got all the questions. I will follow up with a few of you that had questions about the broker program, and then Leonard will definitely get in touch with you tomorrow and get the ball rolling on that. We'll help you with your IRA custodians forms also. They typically have a direction of investment form. So I appreciate everybody's time, and more than that, I appreciate the opportunity to actually be able to be on the CEO Fireside and talk to you guys about what we're passionate about here, and that's investing in alternative investments.